Good morning from Singapore. Welcome to the press briefing on AMRO's quarterly update of the 2023 ASEAN+3 Regional Economic Outlook, or AREO. I'm Lynn Tan from AMRO's Communications Department, and I will be moderating today's briefing. Here with me today is Dr. Khor, AMRO's Chief Economist. In a short while, Dr. Khor will provide an update on the ASEAN+3 region's macroeconomic developments. After Dr. Khor's presentation, we will be taking questions, starting with those we have received in advance. You may still submit your questions in the chat box located at the bottom right of your screen throughout this session. We would ask you to use this function and not the Q&A box in WebEx. You may also unmute your mic to ask your questions during the Q&A session. Please note that this session is recorded for AMRO's archive purposes. Before we begin, we would like to remind you to mute your mic during the presentation. I now invite Dr. Khor to take us through the AREO update. Dr. Khor, please.
Thank you, Lynn. Good morning, and thank you for joining us. In our last briefing for the year, I will focus on the key developments in the ASEAN+3 region and changes to our assessment since July. I will also present our outlook for next year. Let me start with the US and Europe. Growth in the US and Europe have remained resilient. It's been stronger than expected. And for the US in particular, I think the growth is now substantially above what we had forecast earlier in the year. The bulk of economic activity in the first half of the year was driven by demand for services. Since then, pent-up demand for services has moderated. You can see that on the gray line in the chart on the left-hand side. At the same time, spending on durables such as motor vehicles have picked up, an early sign of improving consumer sentiment. And that's the green line in the chart. On the inflation front, there was an uptick in headline inflation in the last few months. You can see the chart on the right side, reflecting higher global commodity prices. Core inflation has remained higher than headline inflation in both the US and Europe. As such, interest rates are expected to remain high for the rest of the year. In fact, market, I think, is expecting one more rate hike this year. Growth is consequently likely to moderate in the second half of 2023 and remain subdued in 2024. I think at the moment, the expectation is that growth for next year will be lower than this year. Turning to China, growth has not been as strong as expected. Real estate investment remains weak as the financial distress among major property developers worsened in the last quarter. That's the red line in the left-hand chart on the left. However, fixed investment for other major sectors, such as manufacturing infrastructure, continue to expand. Particularly a high-tech manufacturing investment, I think, has been expanding quite strongly. The swift and wide-ranging policy measures announced by the government have eased financial market uncertainty and will support growth. However, these measures will take some time to take effect. In this quarter's report, we have a box that assesses the spillovers of China's property market challenges for the region, and I invite you to take a look. Despite the negative headlines on China, we should keep things in perspective. Besides the real estate sector, other areas of the economy are seeing gradual improvement. For example, manufacturing PMI has seen tentative signs of a turnaround driven by higher new orders. Manufacturing output has also continued to expand. And the latest PMI for manufacturing in September is now slightly above 50. On the consumer front, online sales, the green line on the right side, and spending for durables and retail products have also remained firm. Turning to regional exports, goods export for the region is still weak, but there are tentative signs of improvement. Growth in export volume, the gray bar on the left-hand side chart, has turned positive, but growing at a slow pace, mainly reflecting the weakness in China's exports. If we exclude China, 7 out of the 9 regional economies saw improving export volumes in the third quarter. On the right-hand side, the slower contraction in non-tech exports, the red line, is mitigating the weakness in chips-related export, which is the gray line. For example, auto exports grew about 50% in the first half of 2023, benefiting from the improvement in durable goods demand in the US. Chips export is expected to pick up next year in tandem with the global tech cycle. We also have a box article on this report that explains this turnaround in more detail. Meanwhile, tourism recovery remains on track. Tourist arrivals have currently exceeded 70% of the pre-pandemic levels across the region. ASEAN+3 tourist volume is expected to return fully to its pre-pandemic level next year as outbound Chinese tourism picks up pace. So with the external sector remaining lackluster, domestic demand is still the main engine of growth for the region. Steady recovery in the labor market, improving household incomes have supported private consumption, the red bar on the left-hand side chart. Retail sales have remained firm, boosted in part by the recovery in travel and tourism. Headline inflation increased in recent months due to higher energy and food prices. The current adverse weather conditions due to El Nino, compounded by export restrictions, have led to a renewed increase in global food prices. You can see that on the right-hand side chart. Oh, on the left-hand side chart, yeah, sorry. Energy prices have begun to increase due to crude oil supply cuts by Saudi Arabia and Russia and low inventory in the US. The higher energy and transport costs could have spillovers to other sectors. So you can see that on the right-hand side chart, the red line. So these three charts are the regional markets. Concerns over China's growth prospects and expectation of additional global interest rate hikes have impacted the region's financial markets. Equity markets, the left-hand side chart, weakened in the third quarter, mainly reflecting renewed investor concerns over the situation in China, especially in the real estate sector. At the same time, continued interest rate hikes in the advanced economies have placed downward pressure on regional currencies and push up regional bond yields. That's the middle and the right-hand side chart. We now come to the global forecast for the region. Overall, the ASEAN+3 region is expected to expand by 4.3% this year. The two columns on the right-hand side are our latest forecast. The two in the middle, our forecast in July, and the first column rather is for 2022. And as you can see, growth for this year is forecast to be 4.3, lower than in July, but much higher than in last year. And the main difference is China. We have shaded growth down from 5.5% for China in July to 5% now. But we expect growth to pick up again to 5.3% next year. And the main reason for the much stronger growth this year is because of the reopening of China and the strong rebound. For the rest of ASEAN countries, you can see that most of the growth has been shaded down slightly. So growth for the whole region is 4.5%, 4.4, just slightly lower than our estimate in July. And you can see from the red color that quite a number of the countries the growth rate have been shaded down. Philippines, for one, from 6.2 to 5.9. Singapore from 1.3 to 3 to 1, and Thailand from 3.9 to 3.5. So for some of this growth, although we have shaded down, we are still probably slightly above consensus. Vietnam, on the other hand, has been reduced quite a bit, has been raised from 4.4 to 4.7. We have a IMF AMRO team which is just in Vietnam. For next year, we expect growth to remain to pick up slightly to 4.5% for the whole region, and for the ASEAN region to pick up to 5%. So we expect growth to be relatively robust next year, reflecting basically an improvement in export external demand. This table shows our forecast for inflation. Headline inflation is continuing to trend down. So for this year, we expect growth, headline inflation to come down to 2.4% from 2.9% last year for the +3 region. And then for ASEAN to trend down to 3.2 from 4.7% last year. We need to exclude the Laos and Myanmar because inflation in those two countries are very much driven by the spike in depreciation. But otherwise, inflation is continuing to trend down a bit faster than what we had expected. And for next year, on the other hand, we expect inflation to pick up slightly relative to our forecast in July. And that you can see from the red color. Most of them are shaded red because we have revised them slightly higher for next year because of the food prices. So there are various risks to our forecast. The left-hand side is our regional risk map. The bubbles are the major risks facing the region. First is global commodity prices may spike up again due to an escalation in geopolitical conflict, supply restrictions, or El Nino. Second, continued tightening of US monetary policy could lead to financial distress that could spill over to the region. A good example is the Silicon Valley Bank. As it turns out, the impact on the region is quite small. But going forward, if rates continue to remain high, there could be other distress in the US financial markets, especially commercial property. Third, China's growth may be lower than expected if the property market or consumer sentiments were to weaken further. Our scenario analysis found that the GDP for the ASEAN+3 economies, excluding China, could be 1.6 percentage points lower than baseline. You can see that on the right side. Should China grow by 1 percentage point lower, or 4.3% instead of 5.3%? Fourth, the risk of a recession in the US and Europe could not be ruled out. If a recession does occur, so if GDP were to contract by 0.5% in both economies, growth for the ASEAN+3 could dip below 3%. That's the red bar on the right side, the left side red bar. In the medium term, if the geopolitical tension between the US and China would escalate further, and there's a further decoupling, this could have major implications for trade and investment, and that's the bubble on the far, at the bottom on the far right. So I now come to our key messages. Growth for the ASEAN+3 is weighed down by weak manufacturing exports in 2023, but it's expected to strengthen in 2024. Resilient domestic demand, continued improvement in tourism, and a recovery in manufacturing sector will underpin this improvement. China's growth will pick up pace as policy measures gain traction. We expect the real estate sector to stabilize and pick up, and manufacturing exports to recover next year. Export growth will improve next year as tourism recovery is augmented by the recovery in goods exports. There are still many downside risks, including the risk of resurgence in inflation. So let me stop here. Be happy to take questions. Thank you.
Thank you, Dr. Khor, for your presentation. Now we will start to take your questions. You may type them in the chat box. Please identify yourself and your organization when you send in your questions. If you prefer to speak, please click on the raise hand button at the bottom of your screen, and I will call on you to unmute yourself. Please state your name and organization before asking your question. We have received a few questions in advance. The first question is on the region's trade performance. The update is quite optimistic about the turnaround in the region's overall trade, especially for next year. What are the reasons behind this sentiment?
Well, the two main reasons why demand growth is weak this year, one is external exports, and the other is the real estate sector in some countries. The reason manufacturing export from the region has been weak is because of the two-speed recovery in the US and in Europe. as we know, growth in the US and Europe were driven by services, but that is beginning to taper off. And manufacturing was very weak, but it's beginning to strengthen. Because of that, we think growth will begin to pick up next year. But domestic demand is very resilient in the region, mainly because the job market is still very strong and wages have still been rising. So because of that, we think growth will continue to hold up, especially in domestic demand, and investment will begin to kick in towards the end of this year and into next year. The other reason is because the real estate sector in China, which was very weak this year, and also in some other countries in the region, will begin to flatten off and begin to recovery next year. But we expect real estate recovery to be a bit weaker because these are real balance sheet problem, and there needs to be a lot of workout between the developers and the creditors. But that's beginning to happen. So we begin to see signs of a turnaround in the real estate sector in China, for instance. Transactions have held up pretty well and beginning to recover. And once the real estate sector recover, it will also stimulate demand for durable goods as well. So that's another reason why we feel that growth will hold up quite well going forward.
Thank you, Dr. Khor. Could you kindly comment on growth in the ASEAN region specifically? Could we get an outlook on ASEAN's performance in the near term as well?
Growth?
Yes.
Yes. So we have the growth forecast here, as I mentioned earlier. This year, we have had to shade down growth rate for several countries in the region because of weaker external demand. But because domestic demand is holding up, the decline has been quite small, across the region, except for maybe China, where we have shaded growth from 5.5% to 5.0%. But we are still, I think, slightly optimistic compared to most of the analysts, because we see signs of recovery already, I think, in external demand, as well as in the real estate sector, and also in the durable goods spending. So we can see, for instance, in this Golden Week, the travel industry has been completely full. You cannot even get I think the high-speed train, and all the flights from out of China is also full. So we are actually quite confident that consumer spending is there, and it's going to show up later this year. For the other countries in the region, you can see from the table here, the second row from the right, that we have shaded down some of the growth forecast for the region. But I think the decline is relatively small, and we expect that growth to hold up for the rest of the year.
Thank you. Our next question is on an issue that all of us are watching closely: inflation and interest rates. You highlighted that inflation risks have increased and that global interest rates are expected to stay higher for longer. What would be the implications for the ASEAN+3 region?
Yes, so that is actually a bit of a uncertainty because of the inflation. We don't know how bad this El Nino is going to be, and so food inflation may spike up this year if El Nino is turned out to be pretty bad. We already see signs of that happening, and also there's been some protectionist action by some countries in the region. So that also is another reason why food inflation has spiked up in some countries. But I think there's been an agreement among the ASEAN countries not to resort to protectionist measures for food. On the other hand, global oil prices is also beginning to pick up. That's mainly because at the moment, because of the supply cut by US and Saudi Arabia, but also the inventory level in the US is pretty low. And I think that has caused market to be a bit concerned about oil prices going forward. And if China would pick up strongly, demand will also increase, and that will add another factor to increasing oil prices. So for those reasons, we think that the commodity prices are likely to be higher next year, and this will put pressure on headline inflation in the US and in the region as well. We already see that in the case of Philippines, where inflation has turned out to be slightly higher than we expected. So for all these reasons, I think regional central bank would have to keep the monetary policy tighter for longer as well. So some central bank may even have to raise interest rate a little bit if necessary in order to contain inflation. But most of them will probably end up holding monetary policy tighter for longer. And so that would put some pressure on domestic demand, especially durable goods spending. But in any case, as I mentioned earlier, overall, domestic demand is quite strong because of employment is strong and income are still growing. So we expect the growth to hold up quite well. So we are not particularly concerned that the higher interest rate in the US will cause any major shock to the region, but we do think that it may, on balance, dampen growth somewhat and keep rates higher for longer.
Thank you. The next question is on the Chinese economy's impact on the region. Given that China is a major trading partner for most economies in the region, to what extent would weakness in China's economy impact the region? And has the Chinese economy bottomed out?
Yes, China is a major trading partner for all the countries in the region. It's important not just because of the trade side, but also because of tourism and investment as well. China has become one of the big investors in the region. So weaknesses in China is likely to feed through to the rest of the region. At the moment, I think what we see is that imports from the region by China may have been weaker because of the recovery in China is still weaker than what we had expected, but it's beginning to improve. And on the trade side, a lot of the export to China is in the intermediate goods. And the intermediate goods feed into the production in China, and it goes and is re-exported to US and Europe. So if export to US and Europe is weak from China, then it shows up in the import of intermediate goods from the region. On the other hand, because the Chinese economy is beginning to strengthen, the final demand for those goods will also depend on intermediate imports from the region. So that is going to show up also in terms of stronger imports from it. So on balance, we think that if when China recovers, it will pull the region up as well. But of course, China is just one part of the total equation. We also need to see recovery in the US and Europe in order for the region to fully recover. So that's one. The other is on the investment side. Investment nowadays, China is one of the biggest investors in the region, not just in natural resources, but in manufacturing as well. We just came back from Vietnam, and we saw that a lot of the investment into Vietnam actually is coming from China as well. They are also shifting the supply chain out from China to the rest of the region. So for different reasons, one is because of the build resilience for exports, but also in the case of Indonesia, because they have a nickel deposit, and the Chinese wants to build up their electric vehicle, batteries and all that. So they're investing heavily in the region for that reason. And finally, they're also investing in infrastructure in the region. So the Bandung Jakarta Railway just opened up, and in Laos we have the Laos China Railway. So China is definitely important for the region, both for trade, investment, and as well as in services side. Yeah.
Thank you. And coincidentally, we have a few questions on Vietnam. What are your views on Vietnam's economic performance so far this year, and what are the prospects for this year and in 2024?
Yeah, Vietnam is slowing down to 4.7%. That's our estimate. We had earlier forecast of 4.4%. So it's been slightly stronger than what we were expecting back in July, because the numbers have turned out to be stronger. But it's a big decline from last year, which is 8%. So Vietnam had one of the highest growth rate in the world last year, and this year is going to be hit. In terms of growth, it's hit quite badly, and that's mainly because of exports. So we can see that because most of the countries in the region are very open, highly dependent on manufacturing export. So when external demand weakens, it hits most of the countries in the region quite severely. But Vietnam is also affected because the real estate sector is undergoing a correction. The real estate sector was booming, until last year. So some of them, because of the downturn due to the pandemic, have uh, have turned down, and so that's another drag on growth in Vietnam. But the I think the downward pressure is mostly cyclical, reflecting exports, which we expect to turn around next year. And on the real estate side, it's beginning to also flatten off. I think, again, like in China, the recovery in the real estate sector is going to be weak. But nevertheless, we expect rebound in the exports, and I think we already see some signs of that. So next year, we are projecting growth at 6%, which I think is on the low side compared to the consensus.
Next, what do you think are Vietnam's major challenges, and what are your views on the government's measures to deal with the challenges? In other words, what should be Vietnam's priorities to improve the economic growth for the rest of 2023?
Well, the Vietnamese government has already taken several measures. They have cut interest rates. They have raised the credit ceiling, for instance, in order to support the sectors affected by the downturn, particularly the small and medium-sized enterprises. They have cut rates several times, quite by about 150 basis points, which is quite significant. They have also taken measures on the fiscal side to provide relief to the enterprises by deferring tax payment. So they have taken several measures on both the monetary and fiscal policy side to support the sectors hit by the downturn. And on the real estate side, they have also taken measures to help the developers to restructure the loans. Again, the real estate sector will probably take a bit longer to recover, but the export sector, I think, is very cyclical and is likely to turn around next year. So, we don't see the need for the Vietnamese government to take a big stimulus approach, big bang approach to support the economy. We think they should help to support those enterprises who've been hit to basically mother through this period. And we think that when demand picks up, the enterprises will recover, and the economy will grow again.
Now we turn to our live questions. We have a few that came in through the chat box. Let me just read it out to you. Louisa from Business Time asked, what were the questions behind the downgraded growth forecast for the Philippines, and what are the main risks that the country will continue to face?
For the Philippines, I think the second quarter turned out to be weaker than we had expected. But we are still actually quite bullish on the Philippines compared to consensus. Our forecast for this year is 5.9. I think it's above the consensus. As Philippines has surprised us last 2 years because domestic demand has been quite strong and it's holding up quite well despite the increase in interest rates. And we think this will continue. So at the moment, inflation has also come off a bit faster than we expected. As you can see from the chart on inflation, we had expected this year inflation to be 5.8, and we revised it down to 5.5% this year. 5.9, yeah. Okay, sorry. So inflation is coming off, although because of the recent increase in food prices, headline inflation have ticked up a little bit. So that's going to be a drag on growth, especially going forward if inflation continues to pick up and it's higher than what we expected. But otherwise, domestic demand is quite strong. It's being supported by remittance inflows, and with the weak exchange rate, we think remittance inflow will hold up quite well. And also the service economy and services has been doing well. But of course, they can do better, if they get a lot more foreign tourist arrival.
When do you expect inflation in the Philippines to moderate?
It's already moderating. It's just sort of tick around because of the high inflation. The food prices have picked up. But we think that's sort of a supply shock, transitory. We need to see going forward, how bad this El Nino is. If it gets worse, then I think the food prices will go up everywhere, not just in the Philippines, but the rest of the region. So on the trend is for inflation to continue to come down, although food prices may pick up. So the core inflation may actually come down faster now compared to headline inflation. But we still expect inflation next year to be lower than this year, 3.8%. So that will be below the within the inflation target band of the central bank.
Okay, do you think that the central bank will have to keep rates higher for longer than most because of the elevated inflation?
Yes, I do. Yeah, that I think so, because I think even the governor has expressed, that inflation will have to stay high until inflation comes down to within the inflation target band, and he has not ruled out even another increase if necessary. So I think it's very important for central bank in the region to be very clear about their the objective to bring down inflation in order to anchor inflation. So how much longer it's going to stay would very much depend on what happens, with some of these factors like food prices, which is a bit of an uncertainty at the moment. Yeah.
Now we move on to Cambodia. We have a question from Khmer Times. Can El Nino have an impact on GDP growth and inflation this year in Cambodia? What do you think?
Cambodia, yes, it can, but Cambodia inflation has come down a lot compared to some of the other countries. Where do we have it? 2.3%. Yeah, it's quite low. We know that in the case of Cambodia, the economy is highly dollarized. So the inflation rate is also tied to some extent to the strength of the currency, the US dollar. And as we know, the US dollar has been pretty strong. But if oil prices goes up, Cambodia will be hit because Cambodia is very dependent on oil imports. But overall, the economy is strengthening because of a recovery in China. Tourism is picking up very strongly. This year, actually, we shaded growth down slightly from what we had expected back in July, but we are expecting growth to pick up again for next year to 6.2%. So the economy is, we are there recently. It's relatively robust. They were hit because of the pandemic and because of the oil prices, but that's fading off, and we think the economy is going to go back up again. Yeah.
Thank you. Our next question is from Tsubasa from Nikkei. Could you kindly comment on the sharp USD rally and its economic impact to ASEAN? Are there any points of caution for certain countries?
The USD?
Yes.
US Treasury bill? Or
USD rally.
Oh, USD rally, yeah, okay. Yeah, no, the USD rally has affected all the countries in the region. You can see it from the chart in the middle. All the currencies are weakened. So although, when you look at your own in country exchange rate is very weak, it's also weak for the other countries in the region, especially Japan. Japan, I think, has crossed the 150 line, right? And Malaysia is now 4.7 plus, and even Singapore is 3.7 now. 1.1 Singapore. Yeah. So all the currencies have weakened very sharply against the US dollar. So does that require regional central bank to tighten policy? I would say no, unless it weaken much sharply than the rest of the region. This is basically, the weakness is a reflection of the strength of the US dollar and the high interest rate in the US. On the other hand, some countries, when the currency becomes too weak, you can see the pass through in terms of higher prices, imported prices, and then they will intervene in order to contain the sharp decline in the currency. But at the moment, I would say that the strength of the US dollar is a problem in terms of the headline value of the currency being weak. But we don't see really the need for central bank to address this in terms of high interest rate. They may need to intervene in some cases if the currency weaken too much, and if there's a risk of a pass through from imported inflation into higher inflation.
Thank you, Dr. Khor. We have another question, but this time from Malaysia. Anis from The Edge Malaysia is asking, could you please share your insights on the Malaysian economy and any particular reason for maintaining the GDP forecast? Thank you.
Our GDP forecast for Malaysia is 4.2. So we have kept the forecast unchanged from. So this is coming from a very high base last year, which is 8.7. So part of the reason for the lower growth this year is because of the very high base last year. But next year we expect the economy to recover back to 5.2. Malaysia is doing quite well. Also in terms of inflation has come off, I think, faster than we had expected. At the moment it's 3.1. So it's very close to the I think the 2 to 3% threshold of the central bank. And we expect inflation to come down further next year. Again, in Malaysia is subject to the uncertainty of the oil food prices, and we know that rice prices have gone up quite strongly in Malaysia, and the government is taking measures to offset the impact on the poor particularly. But we see the fundamentals for Malaysia is quite strong. They are attracting a lot of FDIs, and manufacturing is turning around. So we don't see any reason to change our growth forecast at this point.
Thank you. Also on Malaysia, Xiao Xian from Nanyang Xianbao is asking, what is your view on the Malaysian ringgit, which continued to weaken since early of this year? Is there any necessity for Bank Negara to do something to increase the ringgit?
Well, as I mentioned earlier, the ringgit is not the only currency that's weakening. I think most of the regional currencies are weakening. But of course, they're weakening at different rates. Some currencies are weakening faster than others. Japan is a good example, and Korea is another one. So it's very hard to just focus on your own country's exchange rate. But it may be true that on balance, the ringgit has weakened a bit faster than the others. But as long as there's no pass-through in terms of high inflation because of imported prices and all that, there's really no reason for the central bank to react.
Thank you. We'll now move on to Indonesia. Martha from LKBN Antara has asked, what are the prospects for the Indonesian economy in 2023 amid various global challenges?
Yeah, the Indonesian economy has outperformed, I think, in terms of growth as well as inflation. And we are still quite optimistic about the Indonesian economy doing well next year. So this year we have a forecast growth of 5.0. I think it may be on the low side compared to the consensus. And next year to pick up slightly to 5.2%. Indonesia has benefited in the past from high commodity prices, especially coal and also palm oil. And even though commodity prices have weakened, the external position has still remained quite strong. And because of that, the fiscal position is also quite strong. So on balance, we are optimistic that Indonesia will continue to be able to sustain its relatively strong but robust growth of around 5 to 5.3%. And inflation has come off quite strongly, so there's no reason for Bank Indonesia to respond either.
But why did you lower Indonesia's economic growth projections to 5.3 in 2024?
That's because I think generally the outlook for export, especially for commodities, was quite weak before. But it could be 5.3. It's just that we have been a bit cautious on Indonesia for next year, because it very much depends on performance of commodity and exports. And although we expect manufacturing export to pick up strongly, commodity, especially for palm oil, coal, I think those are two major commodities have weakened this year, and so the outlook very much depends on what happens to those two commodities. Yeah.
What do you think are Indonesia's strengths for its economy to continue to grow in, from now until 2024 amid the global uncertainty?
For Indonesia.
Yes.
Yeah, no, Indonesia, as I said, is doing well. So we're not particularly concerned that growth is going to weaken sharply. We have shut it down a little bit, but really, it's in terms of policy, we don't expect the need to take any major measures. In fact, I think oil, because inflation rate has come down faster than we expected, that would provide a boost to growth. And that's because they were able to cut the subsidies on oil prices, because of the earlier decline in oil prices. But going forward, if oil prices begin to pick up again, then they may have to raise the fuel prices again. So that will be a drag on growth. But overall, I think that the Indonesian economy is holding up partly because Indonesia is very much a domestic driven economy, and domestic consumption is held up very well. So there's really no reason to change our forecast very much for Indonesia.
Thank you. Our next question is on the Chinese property market. Can the property market recovery evolve into a sustained trend? What's your projection of the property market's soft landing path going forward? And how should the authorities solve this problem?
The property market has been a drag on growth. You can see it from the chart on the left-hand side here. It's taken quite a lot longer than we expected. We were expecting that, you can see the slight upturn there. They will continue, but in fact, there's been a bit of a setback. So more recently, we again hear of some property companies having problems. On the other hand, I think the authorities have been responding. They've cut, for instance, the LTV ratios, loan-to-value ratios and all that to support buying. They've also taken measures to make sure that the buildings are completed, the housing units are completed. And then they have also, I think, taken measures to encourage the creditors to work with the developers to restructure the debt. So you take time for the property sector to recover, but we think that there are signs that property sector have flattened off. There's been increases in transactions because of the recent measures by the government to encourage more buying. And also property prices, I think, have begun to inch up, although this on a month-to-month, on a year-on-year basis, they're still very, very weak. So it take time because it's a balance sheet problem for the property market, and there's been excess demand in the past. So they have to work out the excess demand first before the property market can fully recover. And most analysts think this will take at least half a year, if not a year, before it fully recover.
Thank you. We have our last question, and that's on our Asian currencies. So you mentioned ringgit earlier. The question now is, regional currencies have been under pressure lately. How long do you think this will continue? And what are the key factors that will affect ASEAN+3 currencies in the next 12 months?
Well, if I can read the market. Yeah, certainly under pressure, as I mentioned, because of the strong US dollar. And so as long as the US dollar remains strong, currencies will be under pressure, quote unquote. But when you look at the currencies as a group, it's not so bad because everybody is weakening at the same time. I think the problem is if your currency is weakening much more than the other currency, then it may indicate that there's some fundamental problem. But when we look at the the fundamentals of the economy in the region, we don't see actually very strong reason for currencies to weaken much more. So it's all driven by the carry trade, the strong high interest US interest rate, and the strong dollar, and it affects not just the region but also Europe, affects Japan, all the major economies in the world. So this will continue, we think, for maybe for another several months, because at the moment, US, the Fed has committed to higher for longer until inflation comes off, and there's a risk, of course, the inflation may be a bit more sticky going forward because of the commodity prices turning around. And if that happens and they have to tighten further, that will put further pressure again on currencies in the region. But we don't see that as derailing the recovery, and that's the more important part of it. We think the recovery will continue to strengthen next year, except that central bank in the region may have to keep their interest rate higher for longer as well.
Thank you, Dr. Khor, for your insights today. Ladies and gentlemen, we have come to the end of today's press briefing. Thanks for joining us. If we missed your question or if you require more details, please email us at media@amro-asia.org. You can visit the AMRO website to download the report, press release, and Dr. Khor's PowerPoint presentation. If you would like to give us your feedback on today's press briefing, please scan the QR code on the screen. Thank you and hope to see you soon.